suspect there's a lot of room for both. The Bank for International Settlements suggests that the global value of savings and investment assets worldwide in US dollar terms is something like $830 trillion. The market capitalization of all the cryptos combined is $3 trillion. Both crypto and gold, from the point of view of the global market for savings and investment, are irrelevant. Yes, crypto and gold compete with each other on the speculative fringes. But from my own point of view, they're very, very different asset classes. And when you talk about keeping up with the times, I would suggest to you, Amber, that a very deep knowledge of a sector prepares you to keep up with the times as they impact that sector better than any other technology. Perhaps you, as a journalist, and I'm not disparaging journalists at all, perhaps you, as a journalist, to serve your market, have to try to become an expert in many sectors, or perhaps you need to find people who are experts in many sectors. From an investor's viewpoint, where there's $830 trillion worth of different opportunities, I have no need to be an expert, and I have no ability to be an expert in many sectors. I need to stick very, very, very tightly within my circle of competence. It would not be wrong in this set of circumstances to call me a gold bug. I have had periods of time in my career when I owned no gold stocks. I will admit I haven't had a period of time in my career when I could afford to that I've owned no gold. That's a very different circumstance. And I am, as you suggest, guilty as charged. Treasury tips are doing poorly while gold is doing well because the gold buyer right now is foreign central banks. And foreign central banks are disintermediating out of US treasuries, including tips, into physical gold. The weaponization of the US dollar, the extraterritorial imposition of American power on other countries is one of the reasons why those foreign central banks are selling US treasuries, including tips, and going to gold. The US government has no control over their gold. The former question is different, and that requires a fairly long answer. It isn't merely inflation, but rather the excess of inflation, which I would define inflation as the depreciation of the purchasing power of a given currency, like US dollar denominated currencies, relative to the interest yield that one gets. If you believe the US government statistics, which is to say the so-called CPI inflation number, you aren't concerned. The US government would suggest, Amber, that the purchasing power of the US dollar is declining by about 2.6 to 2.9% annually. I think, and the market thinks, that's farcical. If Americans look to the period 2020 to 2025 at the price of groceries, now a political issue, healthcare, now a political issue, health insurance, rents, home mortgages, groceries, gasoline, the idea that the depreciation of the US dollar's purchasing power is 2.6% compounded is farcical. It's more like 7.5 or 8%. And having a US 10-year treasury pay you 4% in a currency where the depreciation of the US dollar is costing you 7.5% means that if you buy a treasury, rather than making 4%, you lose 3.5%. It's in periods of time historically where savers and investors have been concerned about the maintenance of their purchasing power in fiat denominated instruments like the US 10-year treasury that gold has done well. And here we are. I'll take all comers in terms of bets on tariffs. Americans are pretty dumb, but we're not dumb enough to recognize that tariffs aren't taxes. A tariff is a tax by another name. Mr. Trump, for whatever his skill sets are, is pretty good at voicing the frustrations of his base. He is also pretty good at talking without acting. Anyone who reads his book, The Art of the Deal, will understand that bluff and bluster is the central part of his technique. Now, back to the question after my rant. Gold is fungible. If Mr. Trump puts a tariff on gold from Canada, then the Canadians will sell it in London and Shanghai. Gold is completely fungible. The idea that Mr. Trump will be able to put a tariff on gold exports from Canada, as much as Canadians would like to dislike him, which is easy to do, is a non issue. First of all, I think that the prospect of tariffs is fiction. So let's establish that. Having gotten that out of the way, let's talk about your question from a theoretical viewpoint. The US dollar is going to get stronger anyway, because, as my friend Doug Casey says, the US dollar is the worst currency in the world, with the sole exception of all of the others. Um, I don't think that the US economy could withstand a 25% increase in input costs. If United States automakers were suddenly had a 25% higher cost structure than Canadian automakers or Mexican automakers, the competitive position of US automakers, and I'm just picking on the auto sector, relative to automakers around the rest of the world gets obliterated. We are having enough trouble in the United States maintaining our productive base, given our cost structure and the strength of our currency, without a 25% increase in input costs. Once again, from an economic point of view, tariffs are at best entertainment, but much more correctly regarded as fiction. Gold is going to do well because of simple arithmetic. The difference between the yield on US dollar denominated savings products and the underlying rate of inflation in the United States. Tariffs will have no impact on the gold price. The threat of tariffs may have the impact of weakening the dollar as people look at the relative strength of US producers and they think about the impact of a 25% increase on inputs. I mentioned that I've been in the resource business since 1974. I've done business with the Lundin family since 1975. We are now on the third generation of Lundins. The enterprise was started by the late, great Adolf Lundin, and this family has now started and operate companies with a combined market cap in excess of 35 billion US dollars. The idea that culturally the grandchildren of a billionaire remain humble and hardworking is an amazement. But the third generation of Lundin is, I would suggest, as tenacious, as humble, and as brilliant as the first generation of Lundin. I hope that helps in terms of the background. And they run a variety of companies worldwide, as well as being important shareholders of other companies that they have sold assets to. They run Lundin Mining, which is an emerging tier two copper producer that I suspect within a decade will be a tier one copper producer. They run Lundin Gold, which is one of the most successful single asset producers in the gold business worldwide, and I suspect will also grow by amalgamation. They run a particularly attractive junior, NGEX, which has participated in and, in fact, originated the Vicuña discovery in Argentina, which I suspect will be one of the five most important copper complexes on the planet. And they have long history in oil and gas, including a Canadian heavy oil producer called International Petroleum, that I think, well, it has done extraordinarily well. It's a company where rather than issuing shares to the public for money, they are redeeming shares from the public for money. Always a good sign. It's a heavy oil producer in Western Canada, one that will benefit, I think, from your prime minister pursuing other employment opportunities, and also from the potential that our president, Mr. Trump, will begin to lessen the opposition to North America wide transmission of oil and gas, including potentially the Keystone Pipeline. This augurs very well for Canadian heavy oil producers, including International Petroleum. I don't have a favorite. That really depends on the investor. Many investors want one size fits all answers, but given that there's 8 billion people on Earth, there isn't a one size fits all answer. I own the waterfront personally. I'm attracted to the Lundins. I'm attracted to their assets. As I say, I've been investing with the Lundins now for 5 decades. I wouldn't describe myself as a loyalist. I would describe myself as an opportunist, and they keep giving me these wonderful opportunities. I'm an Equinox holder. In fact, I'm a fairly large Equinox holder. It's run by a personal friend of mine, Ross Beatty, who I've invested with now for 4 decades. Not as long as the Lundins, but a long time. Equinox Gold traded off for 2 reasons. They have attempted, I hope successfully, to put a very large mine in Eastern Canada into production, and they've added a lot of debt doing it. That mine is now producing, although it's not up to nameplate capacity. The financial challenges of putting that mine in production caused them to defer sustaining capital investments at their existing mines in the United States and in Mexico. The consequence of reducing sustaining capital investments has meant that their all-in sustaining costs in those operations have gone up. If they are successful in ramping up the Canadian mine on time, on budget to nameplate capacity and begin to generate a lot of cash from that mine as opposed to sink a lot of cash in that mine and use some of that cash to maintain sustaining capital investments in the United States and Mexico, that stock will do extremely well. I went through the same process with Ross Beatty in Pan American Silver 20 years ago, and it had an extremely successful conclusion. I am counting on, I hope wisely, the same out the same outcome for Equinox.